Thanks for choosing GoldSeek.com radio as a trusted business and investing news source.
All right, it's just a real pleasure to welcome back Peter Schiff on this impromptu interview, GoldSeek.com radio.
Hey, Chris, thanks for welcoming me back. Yeah, Happy New Year.
Yeah, Happy New Year to you and your family. So much has happened just since our last chat here on the show. Of course, equity's a little unnerved by the threat of higher rates. This could spill over into our favorite sector, the precious metals. What do you think?
Yeah, well, we had a big move in silver a couple days ago. It was up 50 cents an ounce, 50, 60 cents, just right after they released that weaker than expected Empire State Manufacturing number. It just shot up. And, gold didn't do much because bonds were getting killed that day, one of the weakest days in years in the Treasury bond market. And so that kind of kept gold down a few bucks. But even in that environment, we saw this 50-cent move up in silver, and that looked interesting to me. Silver kind of peaked above some resistance. It looked like a breakout, and sure enough, the next day it was up another 70 cents, and then gold popped 30 bucks. And so it looks like there's some life coming back into the precious metals market, just as the air is coming out of all the bubbles. And a lot of this makes sense to me because last year, nobody was worried about inflation. It kind of started like, well, there is no inflation. Oh, there's inflation. It's transitory. Then, well, maybe it's not transitory. So the Fed is going to have to get tough on inflation and bring it back down to 2%. And in that environment, nobody wanted to buy gold. It was always, well, there's no inflation. We don't need gold. The Fed's going to fight inflation. That's bad for gold. But I think what people are starting to come to terms with slowly is that, yes, the Fed is going to tighten policy, but it's not going to tighten enough to stop inflation. I mean, it may not even slow inflation. Inflation may keep getting worse, even though the Fed is going to, make monetary policy less loose, which is the problem. Less loose isn't tight. You need tight money to fight inflation. If you have loose monetary policy, you're still causing inflation. And so as the markets understand this, gold's going to go up because who cares about nominal interest rates? It's real interest rates that matter. And if real interest rates stay negative, then that is a positive for gold. And I think, but what the Fed is doing, they're not raising rates enough to fight inflation, but they're raising them enough to prick the bubbles because the bubbles in the tech market and the cryptocurrencies, they need more cheap money. They need more and more, like bigger and bigger doses. And now that the easy money isn't as easy, those markets are collapsing. And now people need to get out of those things, but they can't go to cash because cash is still a negative yielding asset because the interest rates are way lower than inflation. Nobody can buy bonds. Bonds are even worse than cash because bond prices are also falling in addition to the money losing value to inflation. So people are taking refuge in value stocks. The stocks that I own for clients I've been buying around the world, good dividend paying value stocks. Some of these stocks are up 20, 30% in the last month on no news. Money is suddenly flowing into the market. I mean, the NASDAQ as of yesterday was down, I think, 8% on the year. The same thing with the Russell 2000. Our accounts were up about 5% on the year. So this is a huge divergence where you got these foreign stocks going up as the U.S. market's going down. And I think the same thing is happening with gold. People are going to gold instead of cash, and they're also going to gold instead of Bitcoin and other cryptocurrencies. It was very interesting. Last year, everybody was gambling that people would buy Bitcoin as a hedge against inflation. Well, nobody was worried about inflation last year. Now that they're starting to worry, they ain't buying Bitcoin. They're buying gold and silver. And so the people who bet that people would hedge with Bitcoin bet wrong. And Bitcoin is going down as gold is going up.
I hope your son has been listening to his dad.
Going down with the ship.
Oh, no, I'm sorry to hear that. But inflation is an ephemeral genie, isn't it? It's not easy to get back in the bottle. We've seen the Fed heads talk about this for decades, and now it looks like they're really having to deal with it. What are the implications, do you think?
Yeah, well, first of all, those expressions are there for a reason. And so central bankers had said you never want to let the inflation genie out of the bottle. That's because they know how difficult it is to get it back in there. That's why it was particularly worrisome when Powell said that, hey, we're going to err on being easy. We don't care. We're going to wait until we see the whites of inflation's eyes. We're not going to be preemptive and try to, get in front of a potential. We're going to wait and see. We're going to run the economy hot. We're going to keep rates low. And then if we end up with an unexpected problem, well, then we'll do something about it because, it's really easy. We have the tools and we'll just deal with that like no problem. And I was always saying, what is this guy talking about? They don't have any tools to deal with inflation. I mean, they have the tools, but they're not going to use them. It's like, I have a tool. I have a headache. What's my tool? A revolver. Am I really going to shoot myself in the head because that's my tool to cure my headache? There's no way. Once you let inflation get up to 7%, you can't do anything about it by raising interest rates by 25 basis points, 4 or 5 times in a year. That ain't going to cut it. When you have 7% inflation, you probably need 10% interest rates. We needed 20% interest rates in 1980. You think if Paul Volker could have gotten away with just raising interest rates by 25 basis points in 1980, you think he would have done it? Obviously, he couldn't do it. It wasn't enough. So Powell doesn't have the firepower to deal with inflation. All he can do is play lip service to fighting inflation. And as more and more people realize that inflation is now a permanent way of life in the United States, that the rate will never be 2% again, as if it even ever was 2%, but it's going to be very high, and we're going to have to get used to it, just like, they are in Argentina. We have high inflation, and that's just a way of life. And when you're in a situation where you have high inflation, what do? You need hedges. You need to be out of dollars. You can't save in dollars. You got to get rid of them, like a hot potato. As soon as you get your dollars, you got to spend them or you got to, buy an asset.
Yeah, high inflation in Argentina is a bit of an understatement, wouldn't you say? I mean, it's something like 1,000,000 to 1 now versus the U.S. dollar. And just a few years ago, you correctly pointed out, it was close to 1 to 1 between the greenback and the bolivar. So, I mean, this can happen quickly, as we learned in Weimar, Zimbabwe. And
people deal with it. I mean, people deal with high inflation. But, because there's no way to fight it in a way that's politically acceptable to the government or the Fed. Because, yes, we could get tough like Paul Volcker did, but what are the consequences of that? It's a stock market crash, a bond market crash, a real estate market crash, and a credit crisis. Because now all the collateral for all these loans has collapsed. So now all the loans default. And now you have a financial crisis. And now the banks are failing. So, it's a massive recession. But not only that, if the Fed raised interest rates, let's say the Fed raised interest rates to 10%, right? All right, well, we have a $30 trillion national debt financed with T-bills at 1%. Well, if that debt rolls over at 10%, now it costs $3 trillion a year to make the interest payments on the national debt, not $300 billion. Well, where is the U.S. government going to get an extra $2.7 trillion if the Fed's not printing it? So that means they have to massively cut spending on Social Security or Medicare and stuff like that, and they need huge tax increases on middle-class Americans, not on the rich because there's not enough money there. So all this is impossible. So they're just not going to do it. They just can't fight the inflation, which is why they never should have let the genie out of the bottle in the first place.
Keep in mind that the Fed head was dealing with a much different economy, 30 years ago. I mean, we were a manufacturing superpower, okay, a powerhouse back then. Today, it's more of a service and intellectual property economy.
Yeah, we had a much stronger economy in 1980. It had been weakened somewhat by the 1960s and 70s and the big government policies we pursued, but there was still enough of a real economy left. We were still the world's richest creditor nation. We still had trade surpluses, but that's not the situation today. I just had this debate again with Harry Dent. He's always deflation. And he keeps talking about the 1930s and how it's going to be like the 1930s. And I had to keep telling him, Harry, this isn't the 1930s. We were on a gold standard in the 1930s. We're not on the gold standard anymore. He is expecting prices to do now what they did in the 30s. That's why he's expecting deflation. And I keep saying, Harry, if you want to get the money from the 1930s, if you want to get a US $20 gold piece, yes, we will have deflation in terms of that money. So prices for real estate, prices for stocks, prices for everything in terms of US legal tender in the 1930s, gold coins, you will see deflation. But you're never going to see deflation in terms of fiat papered money. Those Federal Reserve notes are not going to gain value because the government will print an unlimited number of them to prevent deflation. Right? That's what they've already said. That was Alan Greenspan or Ben Bernanke's rather famous quote. We have an invention called the printing press. We will use it. We will never have deflation. Right? Take the Fed at its word. We will never have deflation.
We haven't spoken to the oil market. You know, we're seeing soaring prices in crude oil on the whole, and some folks are now calling for, I think it's 105 per barrel, West Texas Intermediate crude. It makes gold even more expensive to pull out of the ground and silver, so there's another potential catalyst. Yeah,
you know, oil prices were at 7-year highs. We're north of $86 a barrel. But remember, we got up towards near $150 a barrel in 2008 before the financial crisis. But at that point, the U.S. dollar was a lot lower. The dollar index was around 70, and now it's, 95. So, but for everybody else, for the Europeans, right, oil prices are a lot closer to that $150 record high than in the U.S. But I do think once the dollar starts to drop, which it will, the way it was doing leading up to 2008, that's going to send this bull market into overdrive. And I think we could be back up at $150 a barrel sometime in 2023. I mean, it could happen in 2022, but I take a little bit more time and give it to 2023 to get back up to 150. But that may not be the ceiling. We may go through there. We may go to $200 a barrel. But the dollar is going to have to be a lot lower for that to happen. But I expect the dollar to be a lot lower. But imagine a world where we have $200 oil, because everything is going to be more expensive, not just your oil. Right? It's just an indication of what's going to be happening. But of course, if you think about all the money we've printed, something like 40% or maybe even 50% of all the money that exists has been printed in the last couple of years. So you can't just print all that money and expect the money to have the same value. The money has to lose value. And the way you see that is with rising prices. But here is the worst part about it. We flooded the world with money. At the same time, people stopped working. We stopped making stuff. People didn't go to work. People didn't show up in the factories. And so we didn't produce stuff, but we printed even more money. Think about the craziness of that policy. Supply is going down because fewer people are working and producing. But demand, thanks to the government, went up. So we made less stuff, but we gave people more money to buy the stuff that we didn't make. And now everybody's surprised that prices are going up.
And don't you suppose, though, that much of that money is finding its way back into the domestic United States in our real estate market, bidding up higher prices?
Yeah, look, real estate prices are up. And part of the reason that they're up is because you can't build because it's too expensive. Because the raw materials are expensive, and you can't even get them, and the labor is expensive. I mean, a classic example is where I am in Puerto Rico. I mean, I'm not making these numbers up, but real estate prices have tripled to quintupled this year. I mean, in the last year. And I mean, I know people where you can sell your house literally for 10 times what you paid for it. That is how crazy it is. And we're talking about big numbers, multi-million dollar. I mean, now there's homes in my community that, somebody told me they turned down $75 million. I know there was one property that traded for 50 something, one, at 30, a couple of them just below 30 million. But these were homes that, a couple of years ago were 8 million, 10 million. The homes that were like 1 to 2 million, they're 10 million, 12 million. I mean, it's just crazy. And the reason that this is happening is all this money is trying to come into this community, and there's no inventory, and you can't build because it takes forever. It's not that there's no land. You just can't get the materials on the island, and you can't find workers. Everything. I mean, I've been trying to finish this wine room in my house. The project's been ongoing for over 2 years. It's one little room. I still haven't been able to finish it.
We have a little emergency vehicle we keep in at our home here, and we just wanted a spare tire. It took 6 months to find a spare tire for one of our emergency vehicles.
I've been trying to fix a refrigerator in my condo, been broken. I can't. I had a dishwasher that I needed to repair. It took, I don't know how, 6 months, 8 months to get the parts. For a while I was like, look, let me just buy a new dishwasher. There were none on the island. I couldn't find one. They didn't have any.
We are seeing some more than saber rattling now on the Ukraine border there with Russia and some war games. Do you think this is spooking the markets a bit?
The markets, don't seem spooked to me. The NASDAQ, and the small cap stocks have come off a bit. But, if they were spooked, they'd be going down a lot more if you consider how high they are, right? The markets were priced for perfection, and we're not even close to getting that. But I think, what is going on is this rotation. That's what people aren't seeing. Most of my stocks that I own that are not gold stocks, my gold stocks are not at 52-week highs. But my non-gold stocks, most of them are at either 52-week highs or multi-year highs. So you're not seeing that because people are buying value stocks that they haven't bought in years with the money they're getting from selling the momentum stocks. Because the momentum stocks, now they have downside momentum. You don't want that, right? When momentum stocks are going up, everybody wants to be on board because, you keep making money on paper. You keep having these gains. Well, now the air is coming out of those bubbles, and people have to sell. But what are they going to do with their money? As I said, they can't buy cash. They can't buy bonds. So they're buying dividend-paying value stocks. Where are those stocks? They ain't in America. They're in Europe. They're in Asia. Right? They're not here. Our market is way overpriced. And so that's what's happening. And I'm just seeing my stuff going up. And, I think this year, 2022, is going to be a record year in the outperformance of foreign stocks versus domestic. It's this rotation because a lot of people are just not going to figure this out in time because so many people, they've been riding this train for a decade. They've made so much money in tech and stuff like that. They're in love with their position. Nowhere do you see that more than in Bitcoin. Where it's become a religion, right? And Bitcoin has a 10-year history of just going up and going up and going up. And every time it crashes, well, it goes back down, comes back up again, rather. And so it's conditioned people to kind of shrug this stuff off because they just assume every crash is going to be followed by a run to new highs. And so you have this mentality, too, in the tech stocks. Well, I think we may have broken that cycle, and we're going down for good. And the people that are trapped in these bull markets in love with their positions, they don't know that. And they're not going to know that for a long time. They're going to lose a lot of money before they finally acknowledge reality. But early on, there's a lot of money to be made if you recognize that transition and get out of those stocks that are going to be deflating and getting into the value stocks. Because when I did that debate with Harry Dent, he was about, these stocks are going to crash. They're so overpriced. And I said, Harry, some stocks are going to crash, not all stocks, because they're not all overpriced. There are actually a lot of stocks that are underpriced. It's objective. You have to look at the earnings, the dividends, the sales, and realize that it's the bubble stocks that are going to go down. Real assets are going to go up in an inflationary environment. So you just have to position yourself in the right assets. And, that's what I'm doing. People could get into my funds, my value fund, my dividend payers fund, emerging markets. Those funds are available at all the discount brokers, or people can contact my office at EuroPacific Asset Management in Puerto Rico. It's epacfunds.com, or in the U.S. at EuroPacific Capital, EuroPac.com. Speak to one of the representatives about setting up an account to work with me and my team so that we can manage a portfolio for you of foreign, non-U.S. dollar, good value, high dividend paying stocks. that'll probably appreciate in addition to giving you a hedge against inflation. And if I'm right about what's going to happen to gold, I think gold's going 10,000, 20,000, somewhere in there. But in that environment, these little gold stocks, these junior miners, some of these things are going to go up 50x, I think, 100x. And so if you have spec money and you want to, really potentially hit the home run, we have managed accounts that focus on gold mining stocks. And I have a mutual fund, the EuroPac Gold Fund, that's all in gold mining stocks and silver mining stocks. Those stocks, my silver stocks yesterday were up 11, 12, 13% in one day. And that was just on a 70-cent move in silver. What happens when it moves up $2 or $5 in one day? It's going to happen.
I agree with you. And I just wanted to throw in there for folks who are a little more risk averse. You also have a neat fund that manages some of these high flyers, don't you? You and one of your colleagues?
But yeah, Adrian Day manages my precious metals fund. But for people who just want to play it safe, the older people, I have a dividend payers fund, just buying good dividend paying stocks. And some of these stocks, have moved up nicely in the past month as this rotation has begun, but they're still cheap. They have a lot of ground to make up for because over the last decade, people have been using these value funds as a source of funds. They've been selling these stocks to gamble on these momentum stocks. And a lot of the big value fund hedge funds have closed down. They've gone out of business because nobody wanted to invest in value because everybody wanted to go into the casino and gamble. And they're on a losing streak. The money is now coming back into real assets again. Well, my dividend payers fund is the EuroPacific Dividend Payers Fund. It's EPDPX. But there's also a no-load version, too. You got to just look. You got to check, if you're at Schwab or Fidelity, you got to go through. But you can get all the information on my funds on the website for EuroPacific Asset Management, which is EPAC Funds, EPAC Funds.com. And there's 5 funds there, and you can take a look at their prospectus. In fact, you can even buy them directly from me off of my website. But you can also buy them, right in your brokerage account.
Well, we appreciate you and look forward to further commentary in 2022.
Take care. Have a good one.